Welcome to Industry Focus. I'm Nick Sciple. Today, we'll be discussing options, what they are, how to use them, and mistakes to avoid when you do. My guests today are foolish options gurus, Jim Gillies and Jim Mueller. Welcome to the show, guys.
Hey, Nick.
Hey, Nick. Hey, Jim.
Great to have you guys on the show. I talk to you guys, I guess, around the virtual office these days, around Slack all the time, but to hop on the podcast with you guys is fun. As I mentioned, we're talking about options today. Just first off the bat, what is an option?
So an option is a derivative security, and what that means is it derives its value from the price of something else, in most cases shares of some company, and it gives the owner of the option the right to either buy or sell 100 shares per option contract at some agreed upon price, which is called the strike price, on or before some expiration date in the future, which could be anywhere from a week away to a couple of years away. So the right to buy is a call, and the right to sell is the put. And there are always two sides to this story. There's the buyer, the owner of the option, and there's the seller of the option. So there's always two parties to this. And in order to buy the right, the buyer of the option has to pay the seller a premium, which is the option price. And that premium is the seller's to keep regardless of what happens. And so you would, so that's a basic explanation of what options are.
Yeah, just remember, the right to buy, buy is a call, BC, and the right to sell, S, is a put, PS. So PS, BC.
Yeah, I like that.
It's probably the first time I've actually said it on air in 10 years. So, nothing like getting to the point, right?
Okay, so you talk about an option as a derivative. It derives its price from the underlying security that's related to the option. Why would someone buy an option instead of going and buying that underlying security, that underlying stock?
Well, a first reason, what if you're bearish, or what if you think the underlying stock is going to go down? You're actually going to go buy a put option, right? Because a put option profits when the stock falls. But assuming you're positive about the stock, why would you buy a call option rather than buying the underlying stock itself? The simple answer is leverage. If, say, a stock is about $75, and I want to buy, say, an 18-month call option that strikes. Remember, as Jim Mueller said, the strike price is what you would buy the stock for. So let's say the stock is at $75, and you can buy a $75 call that expires in a year and a half, say. You can do that for $11 or $12. So if the stock, say, goes from 75 to 100 over the next 18 months, the buyer of the stock would go from 75 to 100. They'd make $25. That's a 33% return. The buyer of the call, who, let's say they bought it at $11, and I have a very specific stock in mind when I say this. If you bought at $11 and the stock went to 100, that stock, or that call rather, would now be worth $100 minus the strike price 75. So that would be worth a total of $25. 25 over 11, that's what, nearly 150% return. So you buy the stock alone, you make about a 1/3 or a 33% return. You buy the call that I've just described, you make 150% ballpark. So it's pure leverage. The downside, of course, is if the stock doesn't go up, if, say, it only goes to 80 or 75 or even 70 at expiration, you'll still own the shares at expiration, so you can hope for further gains in the future. The option goes away, and let's say the stock goes to $70. So you paid $11 for it at striking at 75. If the stock goes to 70 at expiration, you get a big fat goose egg. So leverage, potential upside returns come with elevated risk of losing the capital in play.
Right. So a $75 stock purchase going to 70 is only less than a 10% drop.
Yeah,
a
7% drop or something like that.
something like that. But if the stock is at $70 at expiration, that call is worthless, and so you have 100% loss. So you get leverage on the upside, but you also get leverage on the downside, and that's not nearly as nice.
Now you could also argue, Nick, that if the stock is at 75, and spoiler alert, the stock I'm talking about is Starbucks, because it's a nice easy stock that everybody knows, and it's about $75 today. If you bought Starbucks at 75 today and you came back a year and a half from now and it's at 70, you wouldn't be terribly upset, right? Starbucks is still, but if you bought the call options, you could say, well, I only put $11 in, as opposed to having $75. So maybe it's not that big a deal. The problem is, if you could buy 100 shares, say, of Starbucks, that would cost you $7,500. And so let's say you got that $7,500 hanging around, and then the call option would cost you $1,100, because as Jim Mueller said, it's 100 shares per contract. So it cost you about $11. It's actually about $11.50, but whatever. So it cost you about $1,100 to buy that. You might say, well, since I've got 7,500 here, what I'm going to do, instead of buying 100 shares, I'm going to buy 6 contracts of the call. So I'm going to spend almost my full 7,500. And then again, if the stock goes up, it's tea and metals all around. We love that. If the stock, say, goes to $70 a year and a half from now, you don't just lose 1,100. You might have purchased more calls than represent more shares than you would have purchased. So the key thing for using options foolishly, that we've drummed into people for 10, 11 years now, is know the reward. Always know the potential rewards. We're usually really good with knowing our potential rewards. Unfortunately, at the Focus, sometimes we forget our potential risks. So always understand, what's my potential reward and what's my potential at risk here.
So I think we've skipped over a couple of concepts along the way.
Sure.
So a call, remember, is the right to buy shares at an agreed upon price on or before the expiration date. So that makes money, that becomes more valuable as the share price goes up, because you can buy shares at 70, to use the example we're using, you can buy 100 shares of Starbucks at 75 if the share price is at 90 or 100. Okay, because you can exercise your call, you can exercise that right and force the other person to sell you the shares for $75 a piece. And then you've purchased shares at $75 in the future when the shares are at 100. The downside to that is, if the shares are at 70 at expiration and you have not yet exercised that right, that option, then why would you pay $75 to exercise the right when you could go on the market and pay 70 for those same shares? Which is why we say the option expires worthless, because nobody in their right mind would spend $5 more to buy the shares.
Yeah, if you can find that person, you should send them flowers.
Right. The other side, the put side, is they make money when the share price goes down, because now you have the right to sell your shares at an agreed upon price. So again, using Starbucks and that $75 strike, if the shares at expiration are 60, then you can force the other side of the contract, the other person in the contract, to buy your shares at 75, when in the market you could only get $60 for them. So that's why a put becomes more valuable when the share price goes down, because it guarantees you a higher selling price than the current market price. And with a call, it guarantees you a lower buying price than the current price if the shares go up. The problem is if the shares don't go the direction you want them to in the time that you've allotted. Okay, so you have to be right on the direction and on the time. And so with buying options, that's why we tend to use really long dated 18-month, 24-month options, to give the share price enough time to move in the direction we want it to and stay there, so that we end up with something worthwhile, rather than saying, oh, I'm going to do this with a 1-month option because I think Starbucks is going to go shooting up over the next month. And that only gives the shares a month to move. And in the short term, we all know, at least I hope we all know, that there's no way to predict the movement in such a short term. You have a much higher chance of being right in your movement direction if you give it a longer term time frame.
So fundamentally, the buyer of an option receives leverage by moves in a stock either up or down. The movement of the option will be impacted at a higher magnitude than the underlying stock would be. However, they exchange for getting that upside. They exchange a limited time frame in which for their thesis to take place. And if their thesis doesn't take place, then you're going to lose 100% of your investment. Whereas, hey, if I own Starbucks and it falls $5 a share, I'm down less than 10%, but where if I own those options that you talked about earlier, there's 100% capital loss potential for me.
Yeah, I mean, yes, Ish. There's a lot. Apologies, fools. We've been doing this for so long, and we've done this so many times that we will probably skip over things. So I'll plug. I'll throw a plug in here for Motley Fool Options, which Mr. Mueller is the advisor of, and which I have I guess I'm the advisor emeritus. I was there for a long time, and now I'm up here in Canada most of the time. Your response there was mostly right, but with the problem with options, and it is a problem because what we've talked about with people for years and years and years is this is a new tool that you're using. When you learn to use options, it's a tool for your investing, for your portfolio to enhance your returns. Okay, and it's a tool that you're going to deploy ideally over the next several decades. And you're going to find some strategies that work for you. But realize that because it's a new tool, it's a new understanding, it sometimes takes some time to get comfortable with the nomenclature, comfortable with the ideas at play. So what you were talking with there, Nick, you were emphasizing or looking at the leverage, which of course, I kind of started with leverage. So it's probably my fault that you quoted leverage. That's one reason, but for example, and again, we're using Starbucks as our whipping boy example, whatever here. So Starbucks, so it's about $75 today as we're recording. And let's say you own it, but you're a little nervous about a second wave of the virus that's going around, and you're concerned that maybe it's going to be a little bit lower in the future, and so you would maybe buy a put alongside your stock. Okay, and remember, the put benefits from if the underlying stock falls, the put gains value because again, the put is the right to sell, and you've bought the right to sell at $75. What you've done by marrying a long stock or an owned stock with a long put is you've essentially insured the price of your stock. Okay, you've essentially bought an insurance policy. That's not really leverage, right? I bought insurance when I wear the same as buying insurance on your house or insurance on your car. I have insured that no matter what happens for the next 18 months, I have protected my value of Starbucks by buying this put. So if Starbucks say goes to 50, just to pick a silly price, Starbucks goes to 50. That would be a 1/3 loss for the shareholder. But the value of a put option, and a $75 put option today is about $12, just over $12. The value of that put would go to 25. So the value of the put would go from 12 to 25 at expiration. And you could just sell the put at expiration and you'd pull in that $25 to offset the $25 drop in stock price. You're not made whole because the cost of the put. You did have to buy the put. So like any insurance policy, insurance costs money. And some people get worried about their stock price. And so they buy options. In Motley Fool Options for years and years and years, we've always emphasized we are more often sellers or writers of options than we are buyers, because if you are insuring your stock price, insuring all of your stock prices, I just said that put for 18 months is about $12 on a $75 stock. That is 16% of the share price. Do you want to pay 16% over a year and a half? Let's call that what, 12% or 11% for a year or 10% for a year? That's expensive insurance. So we are always we're not real big on buying options for insurance or buying options for anything but what we think are sure bets for upside, because it is expensive.
Okay, so that brings me to the next thing I wanted to talk about, and Definitely, folks. It's impossible to cover every possible nuance when it comes to options. So definitely do some side reading. Look into Motley Fool options. Look into the resources that we have at fool.com, and there's great stuff all across the internet. But so if you've done some reading up on options, you're comfortable with that area and want to learn more about it, where would you recommend someone starting if they wanted to dip their toe into investing in options?
I would probably start with a covered call. It's one of the simpler ones to understand, and one of the easiest to set up. Okay, and a covered call is you buy 100 shares of some stock, and the idea is to sell one call per 100 shares with a strike just above the current share price, the price you buy it at. And you get paid for that. So that's income to you. And if the share price moves up to or above the strike price at expiration, then you get that gain up to the strike price. So again, using our whipping boy Starbucks, say it costs you $75 to buy the shares, and you sell it 3 months. Now we're talking 3 months because this is a shorter term strategy that you can do over and over and over again. And note, every time you sell the covered call, you get paid, right? So that's the appeal to this.
Getting paid is good.
Getting paid is good. And so what's I don't have my chain up. So what's a
I have it. No.
So what's a $80 call going for in
an $80 call? So
October?
Starbucks stock price as we speak is just over $75. So let's call it 75. And an $80 call, you would get about $3.15.
So that's
October.
Yeah, so that gives you $3.15 with the promise to sell your shares at $80 because the owner of the call is not you, though. So the owner of the call would pay you 80 in 3 months, and say the shares go up to 79 by expiration. Well, the owner of that call is not going to exercise it because he can buy shares cheaper on the market, as I said earlier. And so then now you've got $3.15, and you can sell an $85 call expiring in January. Okay, and say the shares go up to 82 by January, and so now you've got another $3. So now you've made $6.50, and now you do it again, selling in February, March, April. We do this in 3-month steps, and sometimes I just have to work it through in my head. In April, and you do it for the 85s again because the share price is down at 82, 81. But this time the share price goes up to 90. Now, so you've now made another $3.25. So we're up to $9.75 in income.
Call it $10. Call it $10.
So we're up to $10 in income over 9 months, and we bought it at 75, and now we're going to sell it at 85. So we've made another $10 from the sale price because those shares, you let them be called away, you let them be sold. So you've made $20 over 9 months, which is in real money terms, because we're talking per share prices. A single contract is 100 shares, so that's $2,000. So you've made $2,000 when the share price went up only 15. You've made 20 when the share price only went up 15, so you can boost your portfolio returns by doing that kind of thing over and over and over again, and you can just do that as an income strategy with covered calls and generate a nice stream of extra cash income into your portfolio. And this can be done inside IRA and other tax advantage accounts, or it can be done in a taxable account or in both places. And so that's a very nice strategy. I would not. There's a couple of things to be aware of, though. Okay, this is an income strategy. Okay, income. Those premiums you're being paid for selling those calls. Do not worry what's happening with the share price. Okay. You want those premiums because that's your income, and if you get a and you get a bonus by selling your shares at a higher price sometime down the road. Okay, that's your return. If Starbucks goes to $200,
$250, yeah, exactly.
$250. Okay,
coffee as a service.
Coffee as a service. That would be an amazing story, dominating the financial news headlines. But you have that $85 call that you sold. Shares are way. We're not videotaping. Shares are way above the strike price, but all you get is the strike price. You do not get any of the money above $85. Okay, so remember that. You are selling away all the upside above the strike price in return for that premium. Okay.
Yeah.
So, but if you can do this over and over and over and over again, then it's a nice stream of income. So don't do this on those high flyers, please, because they will move massively high and you don't get any of it.
And you will lose it. Yeah, no, Jim has said here, I think it's really important, Nick, what Jim just said there about by selling a covered call, by engaging in covered calls, you are selling the upside. So you are implicitly saying when you sell the upside in return for a premium, even if it's only 3 months, we've talked about Starbucks, it's at 75, we're selling the upside above 80, like if we're doing a 3-month $80 covered call, you are implicitly saying, by selling the upside above $80, I don't think there is any upside above $80, much beyond the $3 call premium we would get. And there's a time value of money argument you can pull in there as well, but for all intents and purposes, you are saying, I do not believe there is upside beyond the strike price, or if you prefer, beyond the strike price plus the premium. So when you engage in this, there's no moaning after the fact if Starbucks becomes coffee as a service and goes to $200. Because you entered a strategy where you are willing to take a cash premium today in return for the perceived upside. The other thing I wanted to emphasize to lever off of what Jim said there is, yes, you can do this and should do this in tax sheltered accounts where possible. If you do it in a taxable account and you do it with shares that you have long owned, so let's say you have Starbucks going back to the early 2000s or even 2008, fools, you could buy Starbucks in the teeth of the credit crisis. You bought Starbucks for $4 a share. Dead serious. Okay. So now it's $75. You've got a near 20 bagger in Starbucks. That's a heck of a capital gain. And if you start doing covered calls on shares you have owned for a long time and where you have a large unpaid, unrealized capital gain, the day your shares are taken from you, you have just triggered yourself a nice large tax bill if it's in a taxable account. Don't do this. When you are going to do covered calls, we have always advocated the concept of the buy right. Okay, so most people have different types of accounts. They have a tax sheltered account. They have a taxable account, whatever. Wherever possible, set up buy new shares for your covered calls. Even if you already own shares of this thing long term, especially if you own shares in another account with a high unrealized capital gain, buy new shares and work your covered call magic on those new shares. Don't give yourself a tax bill, because we 100% promise. I'm so confident in this, I'm willing to speak for Jim over here as well. We promise at some point you're going to lose shares you don't want to lose.
Yep. So we call this rule number 1. If you do not want to sell your shares, do not write that covered call. So again, always do this with brand new shares. If you only have the one account and you've got some long held shares, buy new shares. And then
another target for covered calls.
Or pick another target. But most brokers will now allow you to specify which shares are sold when the covered call is exercised, if you do it within a certain amount of time. So talk to your broker before you do that to make sure you understand how to set that up, because you don't want to trigger that tax bill.
So when you talk about covered calls, I can hear a lot of beginner investors saying, hey, I have to go buy 100 shares of a stock to even set up this strategy. What would you say to someone like that says, hey, I don't have enough cash to run this type of covered call strategy?
Well, you don't have to do it on Starbucks, right? There are stock prices in the 20s and 30s and teens and even single digits you could do it with. The important thing is make sure it's a company you know and understand. So just regardless of the share price, doing this on Amazon and its $3,000 share price, probably out of the range for most retail investors. I'm confident in saying it's beyond my range, so I'm just not going to do it. Plus, I don't want to sell the upside of Amazon. But you can pick some. There's perfectly acceptable targets at much lower share prices, and so one covered call of a $20 stock, it costs you $2,000 for the shares. You're probably going to get back $1.50 and $2 for the call option, so you're going to get back 150, $200 there. And then it's selling a strike price that's near to the $20, $25 stock price, or $22.50 probably, our strike price. It's not that expensive, really. And if even that is too expensive for you, then fools, trust me, options aren't for you yet. But the options market, yet. They will be there for you when you build your portfolio to a size where you can do that. But just take your time and learn all you can. It's funny. I mean, we could literally talk about covered calls only for a long time. The so-called Bible of options investing, folks, is by Lawrence McMillan, and it's called Options as a Strategic Investment, and it weighs about 78 pounds. It's about 13.
He's only exaggerating a little bit.
It's a heavy book. It's a big book. And it's about I think it's 1,400 or 1,500 pages. I believe I don't have my copy down off the shelf at the moment, but I believe there's something like 8-10 chapters on covered calls. It is easily the strategy, and there are all kinds of different strategies, folks. But it is the strategy that McMillan spends the most time drilling it into your head to understand, because it is very much a bread and butter. And one last point in covered calls, because I don't think we mentioned it earlier, and it ties back to what I said earlier about always know the risk and reward. So Jim's done a very good job of explaining the reward and the repeated nature of covered calls. The risk of a covered call, what's important about it, okay, is that it is really, really, really hard to blow up your portfolio using covered calls. So sometimes people will say option strategies are risky. It is almost nigh impossible to do serious damage to your portfolio with covered calls, because you're not actually taking on the leverage that some other strategies do. You're just running an income strategy. So for newcomers to options, it is comparatively safe. And a lot of times you'll hear, oh, options are so risky, they're so scary. But of course, also, options are where you can make these multi-bagger gains in short order. The scary stuff and the risk of catastrophic losses is the price you have to pay to get the potential multi-baggers. Whereas a covered call is a very simple, it's an entry-level strategy, very, very low risk. Literally, it's actually lower risk than buying a stock. Let's say catastrophically, okay, a $20 stock, you have to pay $2,000 for a contract, or buy 100 shares, right? A covered call on it that say pays you back $2, you're paying net 18. You buy the stock for $20, you get back 2 from selling the call. Then let's say the company is complete utter fraud, goes to zero before expiration. The guy who bought the shares, and that doesn't happen, fools, but I'm just being silly.
Unless your name is Luck and Coffee.
Yeah, well, but even Luck and Coffee is not a zero.
That's true.
Right. I mean, it's not a zero. The guy who bought the stock alone and is out $2,000. The guy who did the covered call is out $1,800, because the stock's worthless, but so is the call that you sold. So it's actually a way of reducing your risk in a position. So a covered call, if you've heard nothing else, this is where you want to start, fools.
And I get that it's boring. I get that it's slow.
It should be.
But it is a much surer route to getting options working well for you and really helping your portfolio over time than spending money to buy a 2-week call that you hope this price will go up high enough, fast enough for you to make your money, when the odds are that you will lose your money instead.
Yeah, at 100% of the money. The people who like to speculate on 1 or 2 month or less than 1 month buying out of the money calls. Out of the money means the strike price is above the stock price. So if the stock price, so Starbucks, again, we'll go back to Starbucks since it's a good example. Starbucks is $75 today. If you are going to buy, say, well, we're recording this midweek, you can buy Starbucks options expiring in 2 days, a $75 or an $80 call, say. Well, that's a pretty bad example. So let's say next month, an $80 call next month. If you say, I think Starbucks can still go up, you're going to spend about $1.60 to buy a 1 month call option on Starbucks. Now, that's not much money, right? It's going to cost you,
$160.
$160 for a month. And if Starbucks is over 80, let's say it goes to 85, you're going to triple your money. Well, the likelihood is Starbucks is not going to go to 85 in a month. It's not. I mean, it'd be nice if it does. I own shares. I'd be happy.
And you're not going to be satisfied with only a few $100s. You're going to buy 10 of these contracts.
Yeah, exactly, or more. So the likelihood is you're going to torch your money because the stock will not go above the strike price. And these options, time erosion in the last month of an option's life can be pretty brutal. That time erosion refers, Nick, to how fast the premium goes away if the stock is if the stock is below the strike price
of a call.
Yeah, so you're gonna see that money go away fairly quickly. So baby steps, be boring, trust us, fools. It is a better way.
It is more exciting than just buying Starbucks and putting them in the wall safe for a while.
Oh sure, yeah.
Yeah, because you're doing something every 3 months, right? So.
So it sounds like you talk about the covered call, the fact that your downside is limited, some of the mistakes that new investors make thinking about all these leveraged returns that you can get, that it sounds like for a beginning option investor, what's really important is to not get your eyes focused on look how much money I can make if the things work out, but to really understand what is my risk if my thesis doesn't play out, particularly in the context of what you said earlier, that the vast majority of options that are bought end up expiring worthless.
Yeah, always understand your risk. The reward will take care of itself, but understand your risk.
Yeah, the fewer unforced errors you make, the better off you'll be. So, but we can talk one more strategy that does give you a bit more leverage, but requires a bit more time in return. And that's called a bull call spread. And this costs less money than a covered call, but it takes 18 to 24 months to work out. So the idea here is, again, Starbucks. So do those strike on $5 or $2.50 increments?
They strike on $2.50, so the stock is at 75. So let's do $72.50 and $77.50. What do you think?
Okay, so a bull call spread is ideally set up using the furthest out in time options you can find. Find that option, then stop looking, as Jim told me once years ago.
Yeah, I was going to say like a decade ago when we were having this chat. It's like,
right.
Go out as far as you can, stop
looking. And if all you can go out is 6 months or 9 months, don't even bother. Okay. Again, because you want to give the share price enough time to move in the direction you want it to move. Okay, so it is buying a call that is striking just below the share price, so the 72.50 January 2022, and it is selling a call just above the share price, so the 77.50 in January 2022 expiration. And ideally, it will cost you right around half that strike price difference. 77.50 minus 72.50 is $5. Okay, and so you want to aim to pay right around half that, so $2.50. So what's the price?
Okay, so the January 2022 $72.50 call option on Starbucks, you're going to pay $12.75 for that. So fools, if you've got your pen and pencil down or pen and paper, so you're going to pay $12.75 to buy the 72.50 January 2022 call. Then if you're going to sell to open the January 2022 $77.50 call, you're going to get paid about $10.40.
Pretty close.
So net, yeah, it's almost like we've done this once or twice, Jim. Net, you are going to pay about $2.35 for this particular spread.
Okay. So 77.50 is above 75 is $2.50 out of 75, which is
It's about 3%. Call it a 3% gain.
Call it 3%. Okay. So if at expiration in January 2022, about a year and a half from now, if at expiration the share price is anywhere from a penny to $1,000 above that the 77.50 strike price, that spread is going to be worth $5. Okay, no more, because
And
that
no
short
less.
the short call is working against you, pricing against you. So all the big gain in the long call is offset by a lot of gain in the short call, the sold one. So $5. So you would close that by buying to close the 77.50 and selling to close the 72.50 in January 2022, and you would close that for as close to $5 as you can manage, probably around $4.90, $4.95. Off of, so you're doubling your money in 18 months.
You're doubling your money effectively off of a 3% upwards stock price move.
Yeah, that's the sweet part.
There's your leverage, Nick.
That's the sweet part. So a 3% stock move gives you 100%, or in this case, a better than 100% return in 18 months. And that is fantastically sweet.
Yes.
Now, as you talked about earlier,
I do have one caveat to that, because I always have a caveat.
Yep.
Yeah. What's the risk, Jim?
Well, there you go.
Okay, there we go. Thank you, Nick. Thank you. The risk is if the stock is below both strike prices at expiration. So if it's below 72.50, as Jim just said, whether it's a penny below, so it finishes at 72.49, or whether it's, say, Starbucks is a fraud, goes to zero. Starbucks isn't a fraud. But you know what I mean. Doesn't matter where it is below 72.50. Below 72.50, both options expire worthless. You lose 100% of the money you invested here. Okay, so that's your risk.
In this case, $235 per contract pair.
Right. So this is all options are risk reward. So your risk is you will lose 100% of the money you invest here. Okay. The reward is the potential reward is you will double, or as Jim says, slightly more than double what you put in. So, and off a 3% move. There's one other little risk to be aware of here, and I apologize in advance. This is slightly esoteric, but it is something to be aware of. Okay. And Jim knows where I'm going, I think. Starbucks is a dividend payer. So Starbucks pays a 41-cent dividend every quarter. They also have a history of raising it. Okay, so there's a good bet that by the time 18 months pass and we come up on the January 2022 expiration of these, I'm willing to bet the dividend will probably be higher. Okay, and so the problem here is when the stock price is above the upper strike price, the option that you sold, the call option that you sold. So above 77.50, you run the risk of that option will be assigned early. So whoever buys it from you will exercise it early to steal a dividend away. Okay. And now there's kind of a weird formula. And the problem is what'll end up happening, the mechanics of this is if that were to happen to you, you would end up being short the shares on the ex-dividend date, because when a call is assigned against you, they pay you the money, the strike price, but then you're short the shares, as you have to close that out later yourself. But if you are short shares on the ex-dividend date, you, Nick Sciple, have to pay the dividend. Okay, so you don't really want that to happen. And look, there's 6-7 dividends between now, or 5 or 6 dividends between now and expiration of these. You're probably good for the first 3 or 4, unless Starbucks runs up to 150. Don't worry about it, because there's something called time value in an options price. There will be sufficient time value. That's what the market ascribes to the option for the chance of being in the money at expiration. You're probably fine for the first 3 or 4. But as you come up to, say, the dividend payment right before expiration, or the one closest expiration, or maybe the 2 if the stock runs away on you, those are where you want to be aware And so maybe you close your spread a little bit before if the stock has run up and you've got most of your value, rather than me going through the esoteric calculation
So
here.
talk to your broker.
Yes.
At least two brokers I know of, Interactive
Give you
Brokers
warning. Yeah.
and TD Ameritrade, I know, give you a warning ahead of time, ahead of the dividend, ex div date of the dividend, saying your option is at risk of being assigned early because technically the remaining time value is less than the dividend. Okay, and we're not going to go into what time value is here or how to find out. You can find that on the interwebs quite easily. And so the person who owns that call is going to exercise it early because they get a bigger economic benefit by capturing that dividend rather than keeping the remaining time value. But the situation is the share price has to be above the strike price of the sold call, from your point of view, the sold call, and the dividend has to be large enough. So
to make it worthwhile. Yeah.
To make that action against you worthwhile. It's solvable. You can get out of it. You can recover from it fairly easily, but it's a bit of a hassle, and you don't want to be on the hook for that 41 or 46 cent dividend that Starbucks is paying.
Yeah.
So there is that one wrinkle. So if you do a bull call spread on a stock that doesn't pay a dividend, then you're home free. I mean, at least you don't have to worry about that.
Or a stock that cooperates.
Right.
Because again, bull call spreads, you don't want to hey, we're doing this via Zoom, so you don't really want to do a bull call spread, say, on a fast grower, like really volatile stock like Zoom. You don't, right? Because who knows where it's going to be.
Yeah, and if it goes up a lot, then all you've got is that $5 or $10 spread, and the shares are up $100. So
exactly. Now the good news is Zoom doesn't pay a dividend, so you wouldn't have to worry about what we just talked about. But for a bull call spread, you kind of want a nice, big, quality company that's kind of boring, frankly. That's not you're not really expecting fantastic upside from, and you're not really expecting, big risky downside. Because I mean, look. If I told you guys, a year from now, you can't look at the market between now and 1 year from today, and I told you Zoom will be either 50% higher or 50% lower, could you favor one of those two outcomes? I don't think you could. I think you could probably say, yeah, I could see Zoom or pick any of the other recent high flyers that were considerably lower, say in March of this year when the market got freaked out about the virus, the pandemic. But if I came back to you and said, hey, a year from now, what do you think's more likely? Starbucks will be up 50% or down 50%. I think you'd probably both be picking door number 3 and going, I think it's going to be within the boundary. Like the most likely it'll probably be, plus or minus 15, 20%. And so those are the kind of companies you want for a bull call spread. You want, again, options.
And for a covered call.
And for covered call, exactly. And options are, I know they get a lot of press in like Robinhood right now, and it's exactly. It's very trendy, and people are getting fools. Options done foolishly should be calming and boring. There's lots of excitement out there in life. You don't need, because again, everyone loves upside volatility. We all love upside volatility. Downside volatility is not so pleasant, especially when you are playing with various forms of leverage.
Yeah, I mean, so it sounds like when you mentioned that the bull call spread, it's almost kind of a way to inject some extra risk into some of these more boring stocks, inject some little more upside into a stock that you have high conviction on that maybe isn't going to rip 100% on you, but you have some high conviction that it's going to appreciate in value.
Yeah, it's a way of leveraging slow and steady, right? Slow and steady wins the race, and bull call spreads can be really fun ways of leveraging that slow and steady return.
All right, folks. So that's a covered call, bull call spread are both two strategies you can try out if you're interested in learning about options. Before we go away, for both of you, both the Jims that I have here, you mentioned Robinhood options becoming very, very popular, at least throughout 2020. What would you say to folks who are just getting started? Last words of advice to them.
If you're a part of a group that is doing this kind of together, like your friends are doing this in trading, don't believe everything they say to you on all their fantastic wins, because I bet they're not telling you about their fantastic losses too. We hate to look stupid in front of others. We hate to admit that we made a mistake, so we're probably not reporting our losses. And if all you hear, if all the echo chamber like things that you hear from your friends is everyone's making money, how come I'm not? They're losing money too. Trust me. They're and if they're saying, "Oh, I haven't had a single loss," they're lying to you, man.
No, I don't believe you.
Yeah.
And look, fools, Jim and I'm not sure, Jim, when you started using options. I can see my third decade looming in terms of my own personal options.
I'm coming up on 1 decade.
Yeah. Okay. So I guess I'm older than I look. No, I'm probably not.
No, you started earlier. You're younger than me.
I did start early. You know, I was in my 20s, and I'm no longer in my 20s. But you know, but the key part of this is, as Jim says, they're lying to you. And look, I'll flat out say, I have probably made every mistake you can make in using options over the years. Okay, if you had a good 3 hours and a nice bottle of bourbon, we could enumerate my errors over the years. I wouldn't change a thing. I learned from all of them. Fortunately, I've been lucky, fortunate, smart occasionally to mitigate, because I never lost sight. And Nick, what you've just asked is what's the thing you'd impress? I never lost sight of the risk and reward. So even when catastrophic things happened, and I've had a couple things which were like, well, that's going to leave a mark. You know, I always knew going in, here's what my potential risk is. And so, you know, you can at least recover from that. And then you also have other various rules which you might impose on your portfolio. So, you know, I have a certain position size and a certain amount of leverage I'm willing to take, and a willingness to cull things that don't work. But always know your risk. And I guarantee you, people who are newcomers to using options, who are finding it out from some of the apps, and I hate to bang on Robinhood, but I'm going to. It's almost too easy. People are using too much. People are using leverage they don't understand, and they're having a good time. And if I can just close with one quick example, there's a particular type of strategy called selling puts. Okay, which I'm not going to go into, but it's very similar to covered calls in terms of risk reward profile. But it's also one of the riskiest things you can do if you don't really fully understand what you're doing. And the problem is, and I've seen this happen over and over and over and over again, is someone takes a small position, like does a small position to try it out, and it works out, and they make a few $100, and this is good. And they'll do it again, and it works out, and they make a few $100, and they feel good. And they start to increase the size of their bets. So instead of doing one contract, they do two, and it works out. And now they made double what they made before. And so now they're starting to gain some confidence, and boy, isn't this fun. And I'm going to sell 5 puts. I'm going to upsize my original bet by a factor of 5. And it works out. And well, now I'm an expert, right? Now I'm going to teach classes on how well I do at this. And the next time I upsize to 10 contracts, and the underlying stock falls 30%, and you get wiped out.
And the reason you get wiped out is because by selling that put, you are promising to buy the shares at the strike price. Yep. The owner is going to sell them to you at the strike price. Remember, that's what the put option is all about. The owner gets to sell at the strike. The seller has to fulfill the other side of that.
Yeah. Remember, I said it's akin to, if you buy a put, it's like buying insurance. If you sell a put, you're the insurance company. You're selling insurance. Yeah. And what happens to an insurance company that sells more insurance than, it sells hurricane insurance in a hurricane corridor? What happens when a hurricane comes through to that insurance company? It goes bankrupt. So don't be that guy.
Yeah.
Right. So fundamentally understand your risk. Keep that in your mind at all times. Don't fall in love with the upside that could happen to you. And I think a fundamentally important thing to realize is if you don't understand what your risk is, you're gambling. And more often than not, you're gambling. I mean, even folks who walk into the casino, at least you know what your odds are. If you don't understand your risk, it's arguably even worse than gambling. So make sure you understand what you're doing. Be cautious, dip your toe in, and lean on resources that you have, whether it's at the Fool or other places online. I want to Jim Gillies, Jim Mueller, thanks so much for joining me to share all your options knowledge. If folks want to reach out to you and ask some more questions, where might they be able to find you?
They can't ask us questions directly because we're not allowed to give answers privately. But if you want to join the option service by way of joining Total Income, drop me a line at jmueller@fool.com, Mueller, jmueller@fool.com, and I'll send you a link where you can sign up for the option service. We have a bunch of boards, a bunch of experienced members who are willing to answer questions, and a whole bunch of educational resources.
Thanks for joining me on the show, guys. As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed, so don't buy or sell anything based solely on what you hear. Thanks to Austin Morgan for making us sound so great. For Jim Mueller and Jim Gillies, I'm Nick Sciple. Thanks for listening, and Fool on.